It's been a volatile start to the year for Australian small caps, with geopolitical events, macroeconomic fears around rising interest rates affecting sentiment, as well as sector-specific impacts around the AI fears over software businesses and what that means for them in the future. Despite this, earnings delivery at the small end of the market has been quite positive, with good revenue delivery, reasonable cost control, and rising commodity prices helping out the small resources part of the market, which accounts for about a third of the index. International equity markets and Australian large cap markets have largely brushed off these macroeconomic and geopolitical fears, with the S&P 500 and ASX 100 indexes trading at or around record high levels. The Australian small cap part of the market, however, has been hit fairly hard, down about 13% from January highs. For us as Australian small cap managers, this represents good opportunities down this part of the market, especially given the valuation and performance gap that has since opened up. Australian small caps are trading on a 1-year forward price to earnings basis of about 15 times, which represents about a 15% discount to the 10-year average of the index, and also about a 15% discount to the Australian large cap index, the ASX 100. That is the largest discount we've seen over the past decade. That throws up opportunities for longer term investors in the space, and we think investors allocating to Australian small caps at this point in the market cycle stand to make good gains over a 3 to 5 year time horizon. We're focused on structural long-term winners in the resources space, which really goes across two commodities. Lithium being the first. Typically what's happened in the past during periods of high oil and high petrol prices is heightened technology change and rapid pace of adoption of new technology. For lithium, this means a greater adoption of electric vehicle and hybrid technology. We're starting to see early signs of that already, and the longer term signs are looking very positive. Additionally, battery storage in terms of grid scale storage is an increasingly important market for lithium, and countries will be looking to adopt this technology at a greater rate given they want energy security and less reliance on oil imports. For lithium, this means high long-term demand, coupled with a sustained supply shortage in the short term, sees us forecasting high prices for a longer period of time. We have one large position in a lithium producer in the fund at the moment and are looking to add further exposure. The second commodity we see as being a beneficiary of current turmoil is aluminium. Aluminium prices are directly linked to high power prices, given it's a very power-intensive industry, and we see power prices globally being elevated for the medium term, supporting aluminium prices. The second impact on aluminium is direct supply reduction from Middle Eastern attacks on aluminium refineries, with outages that could range from 12 to 24 months. We therefore see aluminium and other parts of the supply chain, including bauxite, being quite supportive for prices over the coming 12 to 24 months. The other sector we see as being a winner in the short term from current Middle Eastern conflict is the agriculture sector. This isn't the part of the market we've typically invested in the past, but we do see emerging opportunities in this space. Higher soft commodity prices, including crop prices, cattle prices, land prices, will flow through to the sector, as well as other products such as crop protection products, insecticides and herbicides. This directly benefits a couple of ASX-listed agriculture stocks, including Elders and Nufarm. Two quite different exposures, Elders being at the quality end. They will benefit from high crop protection prices flowing through and high demand for those products, as well as the agency model in the livestock space, where they clip the ticket on livestock sales. So we see Elders as representing an attractive investment at the moment, given modest earnings upgrades expected, a solid pipeline of organic and inorganic growth, and a reasonable valuation. Nufarm is the other agriculture exposure we like, at the other end of the quality spectrum. The company has had a tough few years with earnings downgrades and a stretched balance sheet. However, the tide is turning on both fronts. Earnings upgrades are starting to come through given high chemicals prices and crop protection, as well as high fish oil prices in their omega-3 business. This should lead to a rapid deleveraging of the balance sheet and a debt for equity swap where equity investors will see a re-rate in their shares. This is a high risk proposition, but one we see as representing quite a lot of upside. It's worth mentioning the risks in the agriculture space. If there are diesel and fertiliser shortages, that may lead to farmers deferring crops or impacting their creditworthiness. Generally, these agriculture companies provide long credit terms to farmers, so if there are any payment issues, that may show up down the track in bad debts. But aside from that, we see both stocks as having underperformed the market significantly over the past 5 years, having earnings upgrades potential, which fits our process quite well, and represent value at cheap multiples. So we like the space. So in summary, while it's been a tough start to the year for Australian small caps, we see this as being an attractive entry point for people looking for longer term growth at this end of the market. We see attractive valuations given the performance differential over the past few months, and we see a good range of stock and sector opportunities for investment.